Welcome, everyone, to another episode of the Neoliberal Podcast, part of the Center for New Liberalism. I'm your host, Jeremiah Johnson, and joining me today is Joey Politano. Joey, welcome to the show.
Hey, it's great to be on again.
All right, so we had you just on the show just a couple months ago, but little did we know that there was going to be additional financial and economic and banking shenanigans going on. And so today we're talking about Silicon Valley Bank and its collapse. So I don't know, how have you been dealing with this? What's your 48 hours been like?
There hasn't been a lot of sleep. So just to tell the story of how I experienced this, on Thursday, and this recording is as of Monday, on Thursday, when the bank run kind of started, I was following on Twitter. I noticed the thing happening. I was checking in on it. But I wasn't paying that much attention to it because I had to travel the next morning. You know, I was going to be on a bus to DC, and I had broken my phone. So I only had my laptop with me.
That is a tragedy.
Terrible timing. So I'm on this bus to DC Friday, right? I had done the jobs day coverage so that the jobs numbers were released that morning, got on the bus, didn't have a phone, so I wasn't checking the internet. And then 2 hours into the bus trip, got incredibly bored and was like, I wonder what happened to Silicon Valley Bank. Opened up my laptop, connected to the bus Wi-Fi, and the first tweet I see is FDIC takes Silicon Valley Bank into receivership. And I'm like, oh my goodness. So I'm trying to cover this from this terrible bus Wi-Fi on the trip back to DC. Finally get home, and then I spent the next 24 hours I did not sleep because I was trying to write a piece, just covering what was going on. Then finally got some sleep, and then wrote another piece over the last 24 hours covering the response from the Federal Reserve, from the Federal Deposit Insurance Corporation, and from the Treasury to what was going on. So it's been hilariously hectic.
I imagine that's kind of how these things work when a bank run happens, because bank runs happen fast. There's a famous quote about somebody asked how did you go bankrupt, and they say, well, it happened very gradually and then all at once. And that's kind of how a bank run happens. Things start to get bad, little gradually, and then all at once things go to shit. So let's talk about Silicon Valley Bank. A lot of people probably don't even know who this bank is. This is not like Chase or Bank of America or Wells Fargo or anything like that, the big names where everybody sees them all over the place. This is a big bank, but relatively unknown. So who is this bank and why are they important? Why are they big?
Right. So let's start from there. Silicon Valley Bank was the 16th biggest bank in the United States, which is pretty big comparatively, but it's like you said, nowhere near the size of something like JP Morgan Chase or Bank of America. You could fit Silicon Valley Bank into Bank of America multiple times over, and still have room. But $200 billion.
And it turns out we might be doing that very soon. We don't have a buyer yet, but we might be fitting Silicon Valley Bank into one of those.
You might be fitting them into somebody else. Right. So they have a lot of money comparatively, but it's not an absolute ton the way these massive banks in the U.S. are. And they have a very specialized clientele, obviously, from the name Silicon Valley Bank. You can infer that this is mostly a bank for venture capital companies, startups, people who work at these companies, along with some boutique stuff for very high net worth individuals, mostly in California. So you have this really concentrated deposit base. Most of Silicon Valley Bank's customers are people who work in the tech industry or are tech companies themselves. And Silicon Valley Bank had very explosive growth, I will say, over the last few years, especially since the start of the pandemic, in the same way a lot of tech companies did. If you're a new startup raising money in the tech industry, you go and bank with Silicon Valley Bank. Their advertising was half of all startups in the US would bank with them. And so if startups are raising a lot of money, which they were in the tech boom in 2020, 2021, a lot of money was going to Silicon Valley Bank. So they had like deposits triple just in the course of a few years.
I think that's a key piece of information is they were not the 16th biggest bank in the US. It is in like 2015 or whatever. They really, really grew very fast because in 2020, when nobody could leave their home, tech stocks exploded and the tech sector exploded and Zoom became $1 trillion company or whatever, not literally $1 trillion, but Zoom exploded. All tech stocks were, going to be up forever. A lot of these companies like doubled their headcounts. It was a feasting time if you're in the tech industry. And so they exploded in size as well in terms of, like you said, triple their banking accounts. And what's interesting to me is that they don't do a lot of like traditional banking stuff. What I associate with big banks like Chase, Bank of America, Wells Fargo are America's biggest banks is that they take regular people's money. And I guess Silicon Valley Bank takes some regular people's money, but it's mostly businesses for them. It's mostly not regular people. But then, Chase does a lot of like consumer credit cards and consumer debit cards and like mortgages and car loans and like the typical things that you think about when you think about the kind of It's a Wonderful Lifestyle bank, like your money's in his house and her garden and whatever. And Silicon Valley Bank actually didn't do a lot of that. They don't have a big credit card business. They don't do a lot of like mortgages. So they found themselves in this weird position, right? Where they had a ton of cash. They were like flushed with cash from all these tech companies. And they don't do a lot of regular business. So they had to do something with that money, right?
Right. So you have this core problem, which at the time in 2020, 2021 looked like a strength of the business. You have all these deposits flowing in, right? All these startups are raising a ton of money. If you are, I don't know, the next Uber and you just raised $15 million and a bank comes in and says, hey, do you want to borrow like $500,000 on a business line of credit? You're going to tell them no, because you just raised $15 million. You don't need more money. So you have this inherent mismatch where Silicon Valley Bank's users wanted to borrow much less than they held in their accounts. And Silicon Valley Bank did like niche things, try to cover this. You do mortgages to very wealthy founders. You do lending against startup debt in a very boutique way. You take a lot of warrants in the kind of companies you're servicing. You take equity in some of these companies that you bank for. But fundamentally, no matter what they could do, they couldn't come to a situation where they're lending as much as they have in deposits. So in 2020, 2021, they have all this money come in. They have to put it somewhere. They decide to take a big bet on duration. They buy really safe assets that have longer maturities. So you're thinking of U.S. government debt and mortgage-backed securities. So U.S. mortgage debt. And those things are, by and large, the safest assets in existence. There's very low chance that you don't get your money repaid. So they're taking the risk only that if in a hypothetical world that probably wouldn't happen if you're thinking of 2020, where interest rates went up a lot, the market value of these securities would go down pretty significantly. But, interest rates are really low. They'll stay low for a while. They weren't worried about that at the time. So you take out all these safe assets at very low yields back in 2020, 2021, and then you end up in this situation where the majority of your assets are in these, safe, but very low interest long-term bonds.
And I think it's worth explaining for a second, because it's the key to the whole story here is how interest rates and bonds interact. And it's not necessarily the most natural thing for people who are not in finance. So I think it's worth explaining here for a second why high interest rates make bonds go down. Because look, your basic model of banking is that, people deposit their money in a bank and the bank tries to do stuff with that money and make some money. And, that's where the bank's profit comes from, whether that's, the bank gives out mortgages or the bank does credit cards or, in Silicon Valley Bank's case, they don't really do a lot of that stuff. They couldn't make a lot of loans. And so they just bought assets that they thought would be safe. They took your cash and they bought treasury bonds from the U.S. government that, You buy $1,000 bond, you give over $1,000 in cash, and you get this bond that says in 10 years, I'll give you $1,000. And along the way, you'll get $30 in interest in every year, right? Something like that. And that's what you do. That's how you make a little bit of money from these deposits. And that's a pretty standard model of banking, right? Now, the worry is that you have to hold those. You no longer have the person's $1,000. You have a piece of paper that says in 10 years you can have $1,000 and a little bit of interest along the way. But, as long as there's not a run on the bank, that's okay. As long as there's not a run on the bank, holding that piece of paper is just as good as holding cash. Now, if there is a run on the bank, you're going to have to sell that piece of paper. But again, probably not an issue as long as that piece of paper is still worth what you bought it for, right? If you bought it for $1,000 and you need to sell it 2 days from now, well, it's probably still worth $1,000. Probably nothing changed. But when interest rates rise, that value goes down. So it's worth explaining a little bit why that happens. Do you want to give that explanation, Joey, or do you want me to?
Sure, I'll try to give explain like M5 version of this. But the very simple model, like you said, is if you have in 2020, the U.S. Treasury issues a 30-year bond at a 1% interest rate, right? So it's worth $1,000. It's going to pay you back 1%, and then at the end of the 30 years, you get your $1,000 back. And then in the intervening year, inflation is very high. The Federal Reserve says, actually, we need interest rates to be higher in order to contain inflation. So in 2021, the Treasury is issuing 30-year bonds at 2%. Those bonds at 2%, brand new, you can buy for $1,000, get twice the amount of interest per year, and get $1,000 at the end. So it's very natural. People looking at the bond from last year that yields 1% are going to say it's worth comparatively a lot less.
Why am I going to pay $1,000 for your crappy little 1% bond when I can go get a 2% bond?
Exactly.
I'll give you $970 for that bond. And that's kind of, in a practical sense, that's what happens. And so interest rates go up and the value of your bond goes down.
Right. Now, if you're thinking about this, you realize you could kind of avoid this problem, right? If I bought a $1,000 bond in 2020 at 1%. Which,
by the way, $1,000 bank is about what SVB is worth right now.
It's going to be worth a Snickers bar, don't worry. If I buy a $1,000 bond in 2020, 30 years, 1% interest rate, and someone's saying, oh, I'll give you $970 for it the next year, I can just say, no, I'm just going to hold it. I'll just hold it until it matures or until interest rates come back down and the bond is worth, $1,000 again. So this idea in a banking sense is that if you have securities, you can classify them as available for sale, saying we're going to take it at whatever the market price is, that's what it's worth, and we can sell these into the market as we please, or you can put them as held to maturity, essentially saying, hey, these bonds we're not going to sell. We're holding them on our bank's balance sheet for the foreseeable future, and we expect to be repaid, as the bond matures.
Yeah, it's not an issue as long as, nobody asks for all their money back all at once. Because what you don't have is their money. What you have is all these things that will give you the money back in the long run. And they are reliable, but if you had to sell them today, you couldn't actually get $1,000 for them anymore. You could get $970. And so the problem becomes, what if somebody notices, and what if somebody starts a panic, and all of your customers ask for their money back all at the same time? You might be forced to sell those long-run things and take the loss on them when you didn't want to.
Exactly. And so in Silicon Valley Bank's case, as of likely 3 or 4 months ago, they were mark-to-market insolvent. So if you looked at just the total value of their assets and what you could get if you sold them all piecemeal on the open market, it would be less than their total liabilities.
And so they just to make it like super explicit, because I'm the dumb one here. You're the much smarter guy who has a very successful Substack. But so they were insolvent in the case that they had to sell everything at market value right now today.
Exactly.
It would not have their assets would be less than their liabilities. But if they would have been allowed to, nobody demanded their money back and they'd just been allowed to hold these assets, they would have eventually gotten, in that case, they probably would not have been insolvent.
Right. Banks go mark to market insolvent. I don't want to say all the time, but it's a reasonably frequent occurrence. If you make a wrong directional bet on interest rates, that happens.
They can have a little bit of insolvency, like as a treat.
As a treat.
But
the difference is
no,
like,
that does happen. Yeah, you can survive a little spot of insolvency as long as no one notices, right? Nobody freaks out about it. It's fine. And it almost becomes a self-fulfilling prophecy in some sense. That's kind of what a bank run is.
Exactly. You have this situation where as long as you're liquid, you're solvent. But if you're illiquid, you're insolvent. So both come at you really quick. If people think, hey, this bank is technically insolvent, if it becomes illiquid, they're going to pull all the liquidity, which is going to make it insolvent. In a normal bank's case, right? So if you're not Silicon Valley Bank, a normal bank, the vast majority of depositors and a slight minority of deposits are going to be insured by the FDIC. So the FDIC insures up to $250,000. If you're a normal human being with a personal account, 99% of the time, you have less than $250,000 in your account. Even most, small businesses aren't going to have that much money in their account. And even, I'll point out, most depositors at Silicon Valley Bank did not have more than $250,000 in their account. It's just that the average depositor had 4.2 million in their account. So in aggregate, total deposits at Silicon Valley Bank are 95% uninsured.
And this is a very important point because they're an unusual bank. They do almost all of their stuff. The vast majority of their, I guess, like you're saying, the majority of their users are smaller, but the majority of their dollars come from very, very big accounts. And so most of this was not going to be insured, which set off a panic. And I'll also say it's harder to have a bank run when the bank is very widely distributed, I would say. Like it would be hard to have a bank run on Chase because Chase is just everywhere. You'd have to coordinate businesses across all these different countries. And in addition, you'd have to coordinate the everyday people, the regular folks like you and me who might have a Chase checking account. But Silicon Valley Bank is tightly networked. All their customers know each other. They're all in the same VC group chats and founder Slacks. And this is a kind of an incestuous community. So it seems like it was much easier for the panic to start.
100%. That was a big source of the problem, is that you have this depositor base that, for one, so already was losing money over the last year. As interest rates have gone up, the VC community, the tech industry has, suffered pretty significantly. Funding has dried up. Deposits in Silicon Valley had been declining for more than a year. And this is kind of like the slow measured decline. They were still much, much higher than they were before the pandemic, but declining. And then you have this problem of, all the VCs, all the venture capitalists talk to each other. They all talk to their portfolio companies. All the founders of these portfolio companies talk to each other. And like you said, they're all in the same group chat. So if someone in, the VC Slack channel is going, hey, what's this rumor I heard about Silicon Valley Bank being mark-to-market insolvent? Somebody's going to think, hey, I should actually withdraw all my money right now. That's what Peter Thiel did. I should actually withdraw all my money right now. Also, I'm going to tell all my portfolio companies.
I want to ask, because I've heard that he is probably the one who actually kicked off the run. Other people noticed, hey, is their balance sheet a little fishy? But it seems like what actually tipped this into a run was Peter Thiel apparently told all of his founders, get your money out. He told them early, his founders probably did get their money out before the panic, before everybody panicked. Is that kind of how you've heard the story?
That's, I don't want to, for legal reasons.
Well, Well, no,
I'm
just
not
without
gonna
saying
say.
it as a fact, is that your current understanding?
My
based on
understanding is that he was one of the very first major VCs to come out and say, "I'm worried about this bank and I'm withdrawing all my funds." Like I said, they've had deposit outflows for several quarters now. I think in recent months there's been like this underlying rumor about their balance sheet. People knew, especially people focused on the finance side, knew that they were not doing so well. And if you would look at the share price, at any point over the last 6 months, you'd notice that they're not doing so well. But I think Peter Thiel was like the approximate first major domino, the first person to go, okay, actually, we're getting out and doing it very quickly. And I want to stress that the speed of this is practically insane. As of March 8th, so the story of the week is basically Silvergate, very tiny comparatively bank that mostly did crypto stuff, announces that they're voluntarily liquidating. Then Silicon Valley Bank says that they have sold a decent amount of securities at a loss and that they're going to be raising capital to cover that loss, to recapitalize the bank. And then the next day, $42 billion are withdrawn or attempted to be withdrawn from Silicon Valley Bank.
And see, that's what's insane is I think that could only have happened with Silicon Valley Bank specifically. I don't think there's any other tightly networked group that could have gotten its money out so fast.
It's very hard to imagine, any other bank having deposit outflows that massive. To put in context, that would have been 1/4 of the total deposits at the bank withdrawn in a 24-hour period. And that's not counting, whatever happened Friday morning before the FDIC put the bank into receivership. So we still don't know exactly how many deposits made it out of the bank or how much withdrawals were attempted. But I think it's safe to say that like a massive chunk of money was withdrawn here in an extremely short amount of time. There's possibly other banks where you could have something similar happen, but it's really only this bank could be this large and have something happen to it this quickly.
So there's a lot of things about this that are really interesting to me. And sometimes it's interesting in like a fascinating academic way. And sometimes it's interesting in that like I find it personally hilarious. And by the way, is it wrong to like find particular aspects of a bank run hilarious? Is that a moral failing? Because there are things about this that I just laugh about. I don't know if I should.
I think it's there's some community aspects, especially now that we know all the depositors are going to be made whole. I think, we'll get into that, I'm sure, in a second here. But at least now we can look back and be like, there was some wild stuff that happened in the last week.
I don't even think it's the wild stuff. Like, I want to talk about the wild stuff because the wild stuff is funny too. But the funniest thing to me is just like, look, I look back at 2008, and the 2008 is a collapse that was predicated by like insanely complicated derivative, products and CBOs and MBSs and blah and credit default swaps and blah 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 blah. And it's like you need this almost a finance degree just to understand what happened. And this collapse of Silicon Valley Bank is like we bought treasuries. And then we forgot that the Fed was obviously going to raise rates, which they telegraphed years in advance. Like, it's the stupidest possible mismanagement I can think of is somehow you fucked up holding treasuries. Like, am I wrong to just think that's amazingly funny?
No, it is hilarious in context because these are, like I said, the safest assets known to man. They're literally called risk-free assets in many contexts, because they're the closest you can get to having zero default risk in the real world. And it's remarkable from the perspective, from a few perspectives, because Silicon Valley Bank is not the only bank sitting on pretty big mark-to-market losses. So the total losses in the banking sector, the FDIC said it was something like $620 billion. That sounds like a lot. That's like 3% of banking sector assets. So it's not an insane amount.
Which, and again, yeah, for your typical bank, you can survive like a 3% hit. It's not pretty, but like it's not going to cause you to become insolvent for most banks. But Silicon Valley Bank was probably way over that 3% number.
Right. Silicon Valley Bank had, for one, they had made a insanely concentrated bet on these long-term bonds. So more than half of their total assets were long-term bonds. More than half at peak of the total assets were held to maturity securities. For two, they did this while like knowing that their deposit base is hilariously interest rate sensitive. You know, it'd be one thing if you were...
That's so true. That's so true.
Right. It's one thing if you're like First Republic, which I think we'll talk about in a bit. Your First Republic, you make a ton of mortgages. You made this durational bet where you're saying, hey, we let all these mortgages. We don't think interest rates are going up. That was a wrong bet, and you didn't hedge it as much. But you're, First Republic, you have a pretty diversified deposit base. It's a lot of normal people. It's a lot of, California businesses, a lot of high net worth individuals. You're not worried about them.
You've got other stuff. You've got a bunch of mortgages. You've got a credit card business. You've got all the normal banking stuff in addition to like this pile of treasuries that you bet on.
Exactly. In their case, it was a pile of just straight mortgages. But, if you're First Republic, like, hey, if interest rates go up, that's actually good for my business as a bank. Because if interest rates go up, I will charge higher interest rates on my loans, and I don't have to pass on that much higher interest rates to my depositors. Most banks, when interest rates go up, make more money. It's pretty remarkable to be a bank that loses money when interest rates go up. That's not the majority situation.
But like you said, Silicon Valley Bank, all their customers are in the tech sector. The tech sector seems to be, and this is one of my favorite new phrases, by the way, a zero interest rate phenomenon.
Yeah.
The kind of thing that only exists because we had interest rates at zero for almost a decade, for the better part of a decade, not like continuously, but to a first approximation, the Fed has held interest rates at zero for about a decade. And that has consequences for the economy. And apparently one of those is that helped create the tech sector and the startup boom. When zero interest rates go away, what really suffers is what? It's venture capital funding. It's the startup sector. It's, the tech sector as a whole is not doing very hot right now. Everybody's heard about all the layoffs. And so at the same time that their balance sheet at this bank, all their bets on treasuries are getting slammed by high interest rates. Also, all of their depositors are saying, well, we don't have very much money anymore. We're going to start withdrawing money. Naturally, this is even before the bank run. They were losing money and kind of money was draining out of them because all their startups don't have any money anymore.
Right. So on both sides, you're getting squeezed by higher interest rates, and you, in neither case, appropriately hedged. And so the change in monetary policy over the last year and a half has really hurt them and set them up for this bank run.
I'm sorry. It's so funny because I got into some arguments with people on Twitter about this, and the worst kind of podcast is the one where you just talk about shit that you fought with people about on Twitter. But so I apologize. But I can't understand how people could not have seen this coming. What is probably the single most communicative federal government agency? It's probably the Fed. They telegraph this stuff so far in advance. And the fact that there are banks that still don't hedge their interest rate bets, it's mind-blowing to me,
Right. I want to push back a little bit on that. Just because, like I said, there are lots of banks that have mark-to-market losses thanks to rising interest rates. The Fed, if you had looked at Fed communications at any point over the last year, they didn't expect interest rates to get this high either. That's not what they were communicating. But the part that I don't want to excuse is to say it's one thing to make a wrong directional bet as a bank, as to say, hey, this is what we think is going to happen, and to be wrong about that. That's not a crime. That's not necessarily a bad thing. It happens all the time. It's another thing to put such a concentrated amount of your assets on that bet and to in no way manage the risk associated with that. It's purely the fact that there are other banks that are not collapsed because of higher interest rates, or that didn't see these massive deposit inflows, or didn't have this massive mark-to-market losses.
Yeah, that's what I'm saying.
That's the failure.
The Fed was communicating like, oh, the interest rates might go up to 2.5% to 3%, and instead they've gone to like 4.5%. But if that's not in your scenario planning, if that's like so far out of the bounds of your perceived worldview that you can't imagine the Fed might hike like 1 point more, than they said, then that's a failure, man.
Yeah, and so on your point about like the weird Twitter stuff, because I think that this is probably the first bank run that like was organized via Twitter. There was that weird bank run in the UK a few years ago that was organized through WhatsApp, but this is probably the first one that was organized through Twitter.
Yeah, and maybe I shouldn't be so insulting about Twitter. Maybe like honestly, like we say, oh, don't do a podcast just about stuff on Twitter, but like legit half the news is happening on Twitter these days, and I don't know. This whole thing was organized on Twitter, so I don't know. You had Silicon Valley bros freaking out, typing in all caps and screaming at people, and I don't know.
Right. So there was so many you had so many stories about people like who, to be clear, I think were wrongly affected by this. You're running a small startup, or you just raised money, or you're an employee at one of these companies, and someone comes and tells you that your bank has failed. That's like a very worrying situation that you take seriously. And then there were like so many VCs on Twitter that were not taking this situation seriously and were not doing themselves any favors. And there were so many wild stories about what they did like during this crisis. So the one I'm going to bring up.
What's your favorite? Because there's multiple. We should trade our favorites back.
There's so many, but the one that I was like, I saw this morning, and I was flabbergasted. So Twitter, for people who don't know, has enabled it so you can write like 4,000 character tweets now. So one of these VCs wrote like a 4,000 character tweet about what they did hour by hour during the crisis. And it was basically going like, 9:30, like, or like go to sleep at 2 a.m., wake up at 6 a.m. Like they're on hold with the bank trying to withdraw all their money. They're frantically calling their portfolio companies, trying to get them to move money out, frantically calling other banks, trying to open accounts. And then
they're describing the process of a bank run, basically. Like
right, describing the process of a bank run as it's happening, as they're participating in it. And then the guy casually drops that at like 10:30, which I think had to have been only a couple hours before trading was halted on Silicon Valley Bank. He went in and bought a bunch of shares. He was like, "This is overblown. It'll be fixed in a week." I'm like, "You're participating in the bank run and going, actually, this bank is a great investment." I'm losing my mind. How could you do that? I cannot process the cognitive dissonance of being like, I need to, at all costs, get every single dollar I have out of this bank. Also, it's a great investment. I should really buy their stock.
It's funny because, like you said, what's going to end up happening here, and we can talk about this, but all of the actual depositors are going to be made whole. It's either going to be the FDIC that does it through, the fees on banks, basically. It's not really coming from taxpayers. It's going to be taken directly from bank fees. Or more likely than that, even, is that eventually we find a buyer for this, and the buyer makes them whole. All the depositors are going to be taken care of, but the equity is going to be wiped out. All the people who owned the bank, the shares of the bank, or the people who had loaned money to the bank, not deposits, but had loaned money to the bank, those people are screwed.
Yes, I will say, so that the shares have been zeroed out, and there's, broadly speaking, I think the consensus is no matter what happens, the shareholders will not be getting anything. I will say the bonds are trading at like a 50% haircut. So essentially saying that people expect the bondholders to get half of their money back, which
implies that the depositors will get all of their money back, and there will be something left over for the bondholders.
Exactly. And I think we could actually get into this too. Actually, we'll stay on the VC point, on like the Twitter point for a minute, and then we could talk about like what comes next and the buying process of what the Feds did.
I want to share a couple of my favorites too, because there's more hilarious shit that's happened on Twitter. this is like a staple of the VC world, I think, is that you take any opportunity to like promote your own startup. And so what you would see is a lot of different threads and a lot of different people talking about how this impacted them. And they would be like, I'm a startup, you know, I had my money in this and blah, blah, blah. Here's my experience. And then halfway through the thread, it would stop being really about what was happening and start being about their product and start being about their crappy little startup. And by the end of the thread, they've just been talking about like why you should now become an angel investor in their new startup. And like, I saw so many of these, and honestly, I feel a little bad because some of these people ended up getting like dunked on and ratioed insanely and all, you know, but at the same time, if you take the advantage of a bank run to like pimp your startup to the entirety of Twitter, maybe you kind of deserve that. I don't know. That was really funny to me to watch like this crowd of VCs just could not resist, even in the middle of like maybe their life savings is disappearing. This is a great opportunity to promote my startup. It happened over and over. There was one lady who apparently had like a $600 calendar app that all it did was like write scheduling notes for you, and you paid $600 a month for it. And she was like, I don't know. The whole thing was very funny to me, that just watching like these startup founders in their mode, and like they cannot be gotten out of the mode. Their life savings might have just disappeared, but you never stop shilling. And I laugh at it. Honestly, maybe I respect it a little bit too. I don't know.
it was hilarious because there were so many people who were talking about like, oh, we lost everything. Here's actually what our company does and why you should buy our product and
subscribe to apricotas.io.
The one that made me lose my mind was there was a company that, you know, so they had deposits at Silicon Valley Bank. They did not get them out. So at this point, they are locked out of their bank accounts. So they set up another bank account at JP Morgan Chase, and they sent out like an email blast to all their customers being like, hello, you know, I'm sure you've heard of Silicon Valley Bank. Like, we're still operational. You can still buy stuff. And in fact, all of the stuff in our store is 50% off if you use the promo code BANKRUN. And I was like, that's beyond fair. The promo code BANKRUN? You can't do that.
That's incredible. I like, there's a line at which like self-promotion, it becomes like, okay, a little self-promotion is fine. And then a lot of self-promotion is really cheesy and awful, and you look like a weird person. And then there's a further line where you cross over into like, it's so blatant that at this point, I kind of just respect your, like, the cojones to just go for it. You know what I mean?
Right. I mean, it worked because I saw their ad and I have no idea what their company even does.
One of the great little quips that I've seen, and I forget who said this, but it's remarkable the extent to which high interest rates have like decimated like crappy fake parts of the economy while leaving the real economy totally untouched. Like, we've seen crypto totally collapse in the last year. We've seen like weird startup land, and I don't want to get into the debate about whether weird startup land is good or bad, but like all the startups that are like $600 calendar apps, those are dying right now. Maybe the good ones will survive, but like, it's weird how much the real economy just keeps chugging along. And you do the jobs report stuff. You know this. The real economy is so hot right now. And yet all this other stuff that seems to like have very little real world impact is collapsing. I don't know if you have a take on that or not.
I think it's a really weird situation. You know, part of it is you had this moment, especially over the last year, where there was like peak recession fears, where normal people were getting squeezed and like upset about the state of the economy. I would say that was like June or July of 2022, whatever top ticked.
You even had that debate of like, there was technically 2 quarters in a row where we like had negative 0.2% growth for 2 quarters in a row. And like, does that mean we're in a recession? But like the jobs numbers were like super great that whole time, even though we technically had negative growth. So there was that whole debate, like, did we actually have a recession or not? And I think we came down on no.
Right, exactly. And so I think you had that period of like in the summer where people were really worried about the real economy. And then you had a lot of these supply issues fading out, and you had this like pretty sizable, like you said, underlying strength in the jobs numbers and everything throughout the rest of the year. And then the Fed was like, oh, the economy can take higher rates. In fact, it's taking them much better than we expected. Um, to the extent that it's so much better than we expected that we think it's problematic for inflation. We're going to have to keep raising interest rates. Interest rates are going to have to be higher for longer, in order to get the economy back into an equilibrium. And then in those intervening 6 months, you just had like the real economy in many ways outside of like housing improving, and like you said, like startup land, crypto world just getting vaporized.
So I guess the natural question then here is, one of the things you worry about with bank runs is contagion. That one bank run starts, and then all of a sudden everybody gets worried about the next bank, and a bank run starts there, and all of a sudden we're having a bank runs at a dozen banks, and all of a sudden the system is collapsing. We saw some of that dynamic in previous recessions and financial scares. Do you think there's any risk of that here, or is Silicon Valley Bank kind of a standalone kind of thing?
So I think to understand that, first, it's worth backtracking a bit. Um, if I were to start like a contagion clock over the last, I would say, 8 months, it would actually start with like Terra Luna, the cryptocurrency. When that blew up, that helped to undermine FTX, the exchange. When that blew up, it helped to undermine Silvergate, which was a tiny crypto related bank in California. When that wound down, when Silvergate announced voluntary liquidation, that's part of what sparked the fears about Silicon Valley Bank. And when Silicon Valley Bank collapsed, that's what necessitated the FDIC intervention and the closure of Signature Bank, which was another big-ish New York bank that had ties to the crypto industry. And it's funny that this is like contagion, but purely in a vibes sense, right? There was no direct lending relationship of any substantive amount between FTX and Silvergate. It was just that Silvergate had a lot of crypto deposits, some of which were from FTX, and saw big deposit outflows. And so people worried about deposit outflows at Silicon Valley Bank, and so they started withdrawing deposits.
The whole FTX thing, man, I still can't get over how insane that whole episode was, where there's, and this is one of my favorite things I've ever read from Matt Levine, but he had this whole point about like literally just where did the money go? Like half of their balance sheet was tokens they invented. And so like, where did the money actually go? I don't know. Not to get into that whole thing, but it's a big mystery what even happened to FTX's money.
Right. And a mystery that's like still taking time to figure out. But so you reach this point, you've had this contagion, I'm putting on air quotes here, contagion in the sense that people have lost confidence in institutions, but not in the 2008 sense in which, one institution goes bust and that causes a counterparty risk to another institution. It wasn't like Silvergate borrowed a bunch of money from Silicon Valley Bank, and when Silvergate went under, that meant Silicon Valley Bank was insolvent. It was just that the depositors all got scared because of this rolling chain of defaults. So you have Silicon Valley Bank collapse. I think it's really important to emphasize that the FDIC moved hilariously quick here. They did not even wait until the end of Friday to close down Silicon Valley Bank. That's very unusual. Usually, you want to wait until banks are closed in order to come out and say that a bank has failed. So the fact they intervened so quickly meant that things were bad. And then within a little over 48 hours of the closure of Silicon Valley Bank, so late Sunday, they announced, firstly, that all the Silicon Valley Bank depositors will be made whole no matter what. Secondly, that they're closing Signature Bank, which they viewed as another, risk of this sort of panic contagion. Signature had a lot of crypto deposits. Signature had a lot of business accounts. Signature had a lot of uninsured deposits. So they closed that down too. And thirdly, that the Federal Reserve was going to make a bunch of liquidity available to banks via a new facility where they could lend at par value, they could borrow at par value from the Federal Reserve using held to maturity securities. So essentially saying, hey, if you were in a situation like Silicon Valley Bank, where you have this $100 bond from a few years ago that's market value is like $80. You can borrow against it as if it was $100 for the next year. That'll cover you in the time being and prevent this kind of crisis again. This was like a really forceful response from the US government to try to stem the risk of banking panics.
Yeah, it was a really competent response. And one of the things I did find funny, again, in this whole the social element of this, where people, VC think people, thought leaders and all these dudes on Twitter are all freaking out and writing like all caps screeds about the need for bailouts, which, by the way, is very, very funny that half these dudes are like committed libertarians screaming about bailouts and screaming about the need for government intervention. That's funny on its own. But it was also funny that like nobody seemed to understand how the FDIC works. Like, not to be too cavalier about this, because this is a big bank failure. This is the biggest one in the last 10 years. But bank failures happen like all the time. Like there's like 10 of these a year. And normally there's smaller banks than this, but like the FDIC knows what it's doing. They have a playbook for this. There's little mid-sized regional banks and stuff like that kind of go bankrupt all the time. And like it's normally not a big deal. You find a buyer, everything works out fine. The FDIC knows what they're doing. They're very good at publicizing what they're doing. They put out a fact sheet that says, here's what we're going to do. And all these guys would just kind of ignore all of this and scream about what the FDIC needed to do while the FDIC was already doing it. And in some cases had already announced they were doing it. I don't know. It was very funny to watch. Like, it really is. It's stunning how ignorant a lot of tech people are on anything outside of tech. Like, how does the banking system work? How does the government work? They have like no conception of this stuff and like try to reinvent it from first principles. Maybe that's why they're in startup land. I don't know.
Yeah, and it was a weird thing for me because this is like pretty well known. So backtrack a bit. The FDIC insurance limit.
This is not like an exciting area of finance. This is not cutting edge stuff. How does the FDIC work?
Right. It's important, and there's like a lot of moving parts to this, and I like don't want to minimize the risks too much because evidently the FDIC thought that there were significant risks, but in the wake of 2008, the norm for all bank failures has been to make depositors whole in any case possible. And in this case specifically, not only are depositors being made whole, but it, to me, reads as though the FDIC believes that it can sell Silicon Valley Bank and has chosen, to make depositors whole in advance of selling it because they were worried about, the risk of contagion. They were taking this extremely seriously. They moved extremely quickly with a ton of resources leveraged. And it was just wild, on Twitter, and I know the news stories move quickly. It was like on Twitter, seeing a lot of VCs panicking, seeing people put out things like Sam Altman, the CEO of OpenAI, was like, oh, if this was called Farmers Bank of Santa Clara, it would have already been bailed out. And I was like, it's been 48 hours. It's been less than 2 days. There's a limit to the speed at which an entire financial institution can be wound down. And all of these, in retrospect, look very histrionic to be like, oh, the government is targeting the tech sector, ignoring the tech sector. I saw people who were like, oh, if this was some auto loan, if this was some automaker bank, they would have bailed it out already. And it's like, what? I felt like I was losing my mind. It's like
One of my favorite pieces of commentary on this was from Matt Darling, who had a tweet that was like all caps, like, I have secret insider information that the FDIC is following their standard practices. Breaking. The FDIC released a press release talking about what you're talking about 48 hours ago. It was weird just to see people kind of out of step with reality in some sense.
Right. And I understand like the whole point of a panic is like it's not rational, but there was a lot of it that there was a lot of VCs who I think were not helping their own case, were not helping the case of their portfolio companies.
And Did you see the one guy who was trying to start a bank run, like deliberately trying to engineer a bank run on another bank that it turns out he had shorted.
Yes, there was, and we want to say that that's also unverified, but like he was tweeting out about another California regional bank. It was a bank that the FDIC had likely determined was going to be at risk if Silicon Valley Bank. But they were tweeting that like there's already been a run, basically saying that the bank had already failed.
He was saying like wire requests are not going through. You can't get your money out anymore. Like trying to cause a panic, and that was not true. And it turns out this guy might have done some light market manipulation because he might have a short position on that bank. So we're good. Like I've even seen things where people are like, I've actually reported him to the SEC hotline or something like that. So we'll see if it goes anywhere. But I don't know. The VCs were wild this weekend, man. It was a wild weekend. I hope you've gotten some sleep at this point, basically.
I have. But yeah, I think it moved very quickly, all things considered. And so talking about the response. So on Friday, we knew that Silicon Valley Bank had gone under. There was concerns about contagion to several other banks, mostly regional lenders and banks that would have some relation to the tech industry. So Signature is the one that was the crypto bank that people were worried about. First Republic is the California-based bank that people were worried about. And then there's a bunch of other smaller Western and Midwestern banks that people were worried about. Over the weekend, so the FDIC closed Signature. That was done likely because Signature had a mass of uninsured depositors and had also seen a lot of outflows on Friday. I think the FDIC essentially said that there's no way if we reopen this bank on Monday that everyone doesn't immediately try to withdraw all their money and just knock it out. So they put it into receivership and also guaranteed to all of its depositors. First Republic had arranged something with JP Morgan where they're going to have several $1 billion more in liquidity, and they worked with the FDIC on that. And in this weekend, you had the Federal Reserve and the Treasury coming up with a new fund, a new program at the Fed where banks are going to be able to access liquidity more easily in order to prevent the chances that there's another run. So this is like extremely fast-moving, large material actions backed by significant amounts of U.S. money and public authority to prevent, a bank run. This is like if you wanted a serious come out and swinging response, this is what you got,
Yeah,
and in less than 48 hours.
Betting on the competence, just the technocratic competence of like the Fed and the Treasury is almost always a good move. Like they are probably the most independent, most technocratically capable parts of our government. I would rarely bet against them. I have very high confidence in them, and I think they've done a great job. And frankly, I think that the ultimate consequences of this are going to be very, very limited. Silicon Valley Bank has failed. The tech sector is just kind of another wallop for them. It's a headache for them. I'm sure it will have some level of moderate repercussions in the tech sector itself, which is already a little bit down. But like as far as the wider economy, I kind of expect this to be like a giant nothing burger. Like 2 months from now, none of this will have mattered to anybody who's not like specifically in startup world or in, I don't know. Am I wrong in expecting that?
I think, like there's a significant risk right now. So we're talking about First Republic. First Republic opened today like down 60%. And so they've lost an absolute ton of value over the last week or so. And there are some other regional banks that have done, worse. But I think broadly, if you're looking at this, the Fed and Treasury and the FDIC have come together and said we're staunchly on the side of ensuring stability, and we're going to put a lot of firepower behind that. And
the funny thing is, even though a bunch of bank stocks are down, and it's true, a bunch of bank stocks have gone down. They've gone down enough that like they halted trading on them. But I'm checking right now, and I think the markets have closed, right? It's it's past 6 p.m. Monday time as we record this. The market overall, the S&P 500, was basically static today. It lost 0.1%, so basically nothing. So like the market is not freaking out about this, except maybe a couple banks are losing some value, but like ultimately it seems like nobody thinks this is going anywhere.
Right. I would say people are taking the risks more seriously now, but they're not, panicking. And for Silicon Valley Bank, like you said, the modal outcome is probably that they get bought up. So the debt that are junior to depositors, debts that would be paid after depositors receive all their money, are still trading as if they're worth something. So people expect, someone to come in and buy Silicon Valley Bank. And it makes sense. Their clientele is some of the richest people in the world. Customer acquisition is an extremely costly proposition for most banks. And the idea of like locking in, like I said, some of the richest venture capital people in the world is probably very enticing. I think that they probably had some bids over the weekend. My thought process, as I've been following this, I was very surprised on Friday that we did not get any news of a bank trying to acquire Silicon Valley Bank.
Well, and I will say the UK arm has already been purchased by HBSC. So the UK portion of Silicon Valley Bank is gone. It was sold for literally £1. A Snickers bar, as we like to say.
That's not even a Snickers bar.
Half a Snickers bar.
Half a Snickers bar, a Snickers mini.
Yeah.
Right, so someone's probably going to buy Silicon Valley Bank, even just to get the customer acquisition. I was surprised that no one did it on Friday. I was surprised that no one had done it on Sunday. I think it makes more sense in the context of what the Fed and the FDIC did. I think it's possible that this moved so quickly that on Friday people were not prepared, and that the FDIC saw a situation in which the FDIC saw a situation where if someone like hypothetically JP Morgan Chase bought Silicon Valley Bank and then markets opened the next day, Signature would be wiped out, and they couldn't arrange the sales of both institutions in 48 hours. So they decided to arrange the sales of neither. This is just a guess, a hypothetical. This is my speculation. But that's what I think has gone on over the last 72 hours.
Yeah, because it seems like somebody will buy this. Like, even if you just go, there's a Wikipedia article. You can go on Wikipedia and type in list of bank failures and look at a list of bank failures in the United States and since 2008, since after the Great Recession. And there's a couple hundred of these. They're mostly very small banks or mid-sized regional banks sometimes. And in 95% of the cases, somebody buys them. They go out of business, but somebody buys them and makes all their depositors whole. And that is the standard playbook here. It's well worn. So I'm expecting somebody to buy them, and we'll see what happens. I want to close the podcast with one thought. We'll do one final thought from each of us. What's your main takeaway? What are you looking at towards the future? My final thought here is that I think the real impact this has is going to be on the tech sector and not in the obvious way. I think it's going to be on the tech sector in a way that all of a sudden politics is going to start looking at them with a lot more skepticism than they have previously. And we've already been seeing this. There's already a lot of antitrust energy in DC, and nobody can agree on what they want the antitrust energy to look like. Nobody can agree. Everybody's fighting about social media, censorship and stuff like that. But the energy is there. And I think the real fallout here is that DC starts looking at this, and maybe not even political DC, but regulatory DC as well. The Fed and the Treasury and the FDIC start looking at the tech sector as a systemically important part of the economy. And you might say, well, oh, that's great. They're important. Tech should celebrate. But no, you don't want a regulator to call you systemically important because it means they're going to put a bunch of rules on you. But, just after the last 6 months of Tether and Luna and I don't know, FTX and Silvergate and Silicon Valley Bank and everything to do with tech and crypto kind of seeming shaky, I think they're going to get a lot more regulatory attention than they've been getting. And that might be what really is the long-term impact. That's kind of my final take on the situation. What are you looking at as we move out of this? You know, we're no longer in crisis mode. What are you looking for? Do you have any like final takes that we should be, you know, keep in mind?
I've got a few things. I would say first that I definitely agree on the regulatory crackdown sense. In a few cases, the first being like crypto related stuff. I think there was this push, you know, as crypto was booming to sort of get it intertwined with the traditional financial system, arguing that like, hey, if it's institutionalized, it can be better managed, it can be better regulated or whatever.
And ironically, you know, Sam Bankman-Fried was like the champion of that. He
Exactly.
was the guy who said, we should regulate crypto. Let's have a smart set of regulations for crypto. He was all about that until he did some light bank fraud and malfeasance.
Right. And so right. And so I think the appetite for working productively with the crypto industry is not there anymore. And even not just from a regulatory perspective, but like if you are a normal private bank, do you really want to be associated with crypto right now, given, you know, we just saw the three biggest, you know, crypto tech related banks go out of business within the matter of a week? I do not think the answer is yes. The second point, you know, I think that regulators are going to come back down on the tech sector a bit, and I think that they're going to come down specifically on these like mid-sized banks. There was a lot of lobbying in the years since Dodd-Frank was passed to essentially get it so that banks that weren't quite as big as JP Morgan Chase, but were much bigger than, you know, your small Farmers Bank of Atlanta or whatever, would not be held to the same standards of Bank of America. And the argument was like, hey, if a bank like Silicon Valley Bank failed, it'd be no problem. You know, Bank of America, some smaller bank, some regional bank, or a larger bank would come in and buy them, and it'd be resolved in a weekend, and there'd be no systemic consequences for the U.S. financial system. And so it's hard to argue, like, hey, in regulation, we should not be treated as systemic, when the FDIC is saying, in failure, these are systemic institutions that must be managed accordingly.
What's especially juicy is that Silicon Valley Bank specifically was at the forefront arguing they should not be regulated this way. And if they had been regulated this way, it means they would have had to do more disclosures and more stress testing, and maybe they wouldn't have gone out of business this way. I don't know.
Yeah, and it's also funny because Barney Frank of Dodd-Frank was on the board of Signature Bank. So, you know, there's this weird relationship where they didn't want to be held to the same standards as these big institutions. And I think that's going to change. And I think, you know, more broadly, the Fed has had this idea over the last year or so in fighting inflation. We need to raise rates. Raising rates is going to tighten financial conditions. And they explicitly wanted financial conditions to be worse, you know, for a long period of time. Even at the most recent Fed meeting, Jerome Powell was coming saying that we don't think it's sufficiently restrictive. That's the term they use, sufficiently restrictive financial conditions. And, you know, the fear was like, hey, they were going to move fast, and they recognized that was going to have consequences for the financial sector, and they recognized that was going to have consequences for financial conditions, but they were not too worried about that. I think the most likely outcome of this is what happened in the UK after the liability-driven investment blow up, or in Europe after the sovereign bond blow up earlier last year, where, you know, central bank comes in, creates a new facility, they try to manage the direct financial problem, and then once the direct financial problem is managed, then they move on. They continue to, you know, raise interest rates as normal, trying to get inflation under control. I think right now markets expect a lot less hikes. I think that's probably a correct expectation for now, given the risks for bank runs are still, high. But if that risk fades over the next like couple weeks, I think the Fed is going to go back and be like, all right, we're still, raising rates just as we in a similar way to as planned because inflation is still too high.
We will close with the real culprit here, which, as Ron DeSantis has informed me, is the woke mob. The fact that Silicon Valley Bank had a DEI officer, that apparently is the reason they went out of business. That is the lesson I want everyone to take. I couldn't even say it with a straight face. Man. Go woke, go broke. It actually is very funny that like the conservatives have no idea how to deal with this because this is not like a traditional left-right thing. So they just kind of fall back on like, let's just make it about wokeness again, I guess. But that's the last funny thing
I'll give you. It's especially funny. Well, especially funny to me because like there's an article in the Wall Street Journal this morning being like, oh, they had one black guy and 2 veterans on their board of directors. I'm like, huh? They're like, the Silicon Valley Bank was too concerned with diversity. That's why they failed. And I was like, I feel like I'm losing my mind. And then it was also...
It's actually very worrying.
Yeah. Yes. It's also one of those things where like, banks, in terms of institutions that you want to be non-discriminatory, banks are at the top of the list. And there's a ton of rules to ensure that banks are like not discriminating on the basis of race and gender, that they're, fair in their hiring practices. You have all these like community reinvestment rules. And so a lot of this was stuff that's like, it wasn't like Silicon Valley Bank was uniquely woke. They were just following the laws that are put in place.
Look, Joey.
I was losing my mind.
The thing is, we all know the gays love going long on interest rate risk. And like that's what happened here.
The gays love unhedged interest rate exposure.
Exactly, right? It's part of gay culture, as far as I'm concerned. All right, so our final question that we always ask, what's something you would recommend for people to read on this if they want to learn more? I will recommend, obviously, aprikitas.io, Joey's wonderful Substack. You should go subscribe, give him all your money. It's better than giving it to Silicon Valley Bank. But other than your blog, what would you recommend for people to read?
I would say I very much love Matt Levine's money stuff. And he was great during the FTX crisis. I'm certain he will be great during whatever's going on here in terms of like more capital M macro stuff if you're interested. Mike Consul at the Roosevelt Institute did a lot of work about Dodd-Frank regulations. Joseph Wang, who's Fed Guy 12 on Twitter, does a lot of like, looking at balance sheets and the Fed's tools. I always got to plug the people at Employ America, who I don't think are going to talk about this because it's not their wheelhouse, but they talk about the Fed and macro stuff a ton, and they're great. And I think that will be important more going forward if hopefully we can put this crisis behind us.
All right. Well, I think that's the episode. I hope you guys enjoyed listening to it. Joey, thank you so much for coming on. We'll have to do this again sometime. Hopefully there will be another bank run where we can talk about it. I don't know.
Oh, no. Hopefully I never come back on the podcast ever again.
Nothing interesting happens with the economy.
Interesting. If I could get some
We get
sleep.
1.5% growth for the rest of eternity with no speed bumps. And It's just very boring. Economic commentary dies. Anyway, my guest today has been Joseph Politano. Go check him out at aprikitas.io. Joseph, thank you for coming on.
Thanks for having me.